Most of us are aware of Government Accounting Standard Boards, also known as GASB. As many of us disagree with their approach to accounting rules, Tom Sgouros with Brown University asked whether it is possible to develop different rules that will address some of the rules' shortcomings and offers promising alternatives to the status quo. Please welcome Tom Sgouros.
Thank you very much, Dale. So my name is Tom Sgouros, and I'm part of the research faculty in computer science at Brown University, where I do data science and information theory kinds of things. But perhaps more relevant to what we're talking about today is I was the senior policy advisor to the state treasury in Rhode Island for a few years back. I guess I'd like to start by thanking NCPERS. We're going to talk about a report that I wrote for NCPERS that you see there. That's what you see. And I'd like to thank NCPERS, Michael Kahn, and Hank Kim for sponsoring the production of this report that I'm going to present to you. But to begin, I'd actually like to start talking about yacht racing. So in the 1960s and 70s, there was something called the International Offshore Rule. There's still a remnant of it. This was a handicapping rule that sailors used to correct the times of boats so that different boats could compete with each other and they would compete on corrected time. The rule sort of favored short boats and fat boats because those are slower. And, but here's a couple of the boats that were produced to race under the rule. And if you look at the boat on the left there, you'll see that that's not actually a fat boat. It's a skinny boat with a little bulge in the middle to make it appear like a fat boat. And that green boat on the other side, that's not a short boat. That's a long boat that is holding its bow and its stern up out of the water a little bit, but it has kind of a round cross-section so that it tips over easy and the ends go into the water and it becomes a long boat, which I think is kind of cool. I think it's sort of a law that for any person who can invent a rule, there exists another person who can invent a way to subvert it. So this is cool, but like, what's exactly the problem? And the problem is that it's not always, calm seas out there on the water. And you can make jokes about high-strung thoroughbred behavior and stuff like that, and everybody can laugh about it until there's a race. And the 1979 Fastnet race, 100 boats of this type got knocked down. 77 of them turtled. 5 of them actually sank, and 18 people died. And remember, this is a sport. So one of the other responses was that in addition to the horror of it, one of the responses was that the International Offshore Rule was changed. It was changed to encourage more seaworthy boats. It was changed to increase ballast, to increase the topsides, and to get rid of some of the ways that people had been gaming the rules. So I want to draw an analogy to GASB, the Government Accounting Standards Board. In the early 90s, they established, with statements 25 and 27, they established rules for comparing pension systems to each other, and it appeared to everybody that they were revealing a slow-boiling pension funding crisis. In 2012, GASB kind of doubled down on this with 67 and 68, and I guess I'd argue that they went about changing the rules in almost exactly the wrong way. Rather than change the rules to encourage more seaworthy boats, they simply increased the penalties for sinking. And they also had people reveal in public the dimensions of their boats, hoping that public shame would sort of do some of the work for them. And I guess the spoiler alert here is that it didn't. And I don't have to go through it. You guys know the litany, right? There's Illinois, Kentucky, New Jersey, Chicago, Detroit, Los Angeles, New York City. I live in Rhode Island. This has its own problems. Central Falls in Rhode Island, Stockton, California. You can go on. The Pew Charitable Trust report that state funds have $2.6 trillion on hand to deal with $4 trillion worth of liabilities. And, $1 trillion shortfall is a lot of money. But on the flip side of it, what other government expense is pre-funded for the next 50 years, right? And these are puzzling questions about what's the right way to do it, and I mean that kind of seriously. So I think in any debate, it's useful to think about the fundamental questions. I mean, that's how you evaluate the arguments. And I think it's why we should think about the accounting rules themselves. So one question I have is, well, why have accounting rules at all? Why not just, why not just collect the money and spend it? What's the problem there? And the answer is, I mean, there is an answer to this. It's not just because we employ accountants. The answer is that the rules are there to answer the question, how's it going? How's our project doing? What are we, how's everything working? But we also use the rules to do other things. We use them to compare similar enterprises. So you can compare a system in Arkansas with a system in Illinois. And then we also use the accounting rules to evaluate hypotheticals. And we use them to evaluate the urgency of action as well. But with all of these things, it's important for us to remember that the accounting rules are not reality, right? They are a portrayal of reality. It's sort of like when you go outside and you can classify the birds in different species, and that's cool. But you have to remember that that's not the bird's reality. That's it's our interpretation of reality. And accounting rules are kind of the same way. So then the obvious question is, well, why not just change them? And the truth is that accounting rules change all the time. They often change in response to a crisis. And they often, in the context of a crisis, they often change at the behest of powerful institutions. Like, for example, when in 2008 and 2009, all the bank regulators decided to go easy on the banks rather than declare them all insolvent. There's a whole bunch of other examples of this. The Uniform Management of Institutional Funds Act became the Uniform Prudent Management of Institutional Funds Act at the behest of the owners of really large endowments like Harvard and MIT. There's also issues about how accountants deal with off-balance sheet transactions. Stock options are something that get accountants arguing with each other almost at the drop of a hat. And then there are a whole bunch of issues about just looking at risk on balance sheets. And these are controversies within the accounting profession that I think are worth considering. So let's talk about pension accounting and the rules themselves. And the first part of it is the one that I think everybody's the most familiar with is what about pension debt? I mean, when you look at pension debt, it's actually a little bit weird in some ways. I mean, it's a debt, it's said to be a debt, but it doesn't appear to be anybody's asset. Where's the other side of the balance sheet for a pension debt? The pension debt appears to be valued at essentially zero, which is unlike pretty much any other obligation, any other government obligation, ranging not only from revenue bonds or general obligation bonds, but right down to purchase orders. I mean, you can borrow against the government purchase orders. The debt is due. It's required to be paid decades before it's actually due to the retirees. And the more you look at it, the more you think, well, I don't know, this is less like a debt than like some sort of exotic accounting structure. And then the fundamental part of it is that it's not actually a neutral act to take this kind of odd accounting construct and force people to declare it in the government's net position, statement of net position. That's not neutral in terms of funding policy. And in fact, what that does is create a certain amount of political risk. And if the political risk involved with making that appear on a balance sheet means that a pension system gets closed, well, that hasn't helped anybody have a more secure retirement. Another thing to consider is normal costs. I mean, normal cost is sort of a funny concept. I mean, what's actually normal about them? The word actually comes from accounting for manufacturing, where there's actually a legitimate question about, well, how do you account for the cost of a manufactured good? Do you use the average cost of the goods over the course of a year? Do you use the cost on the invoice? Do you use, and what do you do about things like, repairs to the bathroom on the factory floor? Is that part of the cost of goods or not? Or these are questions. So what a normal cost is about taking, creating sort of a standard overhead cost that you're going to add to the cost of materials And for government, the cost of materials is mostly ignored, and you just wind up with the kind of estimate for the standard cost. But the funny thing about it is that we use estimates to generate the normal cost, but we also use estimates, whereas in manufacturing you might use estimates to do your budgeting, but you'd go back and you'd do a retrospective analysis to correct it. With pension funds, you never really do that. You use probabilities to estimate the cost in the first place, but you also use probabilities to do the corrections, which is also a little bit kind of odd when you think about it. We also, the other funny thing about normal costs is that there's probabilities everywhere, and we assume that the probabilities cancel out in the limit of large numbers. And that is basically the central limit theorem of statistics. But the central limit theorem isn't an automatic thing. It comes with conditions, basically that the trials have to be independent and identically distributed. But with a pension system, they're not identical. If you change the population that you're recruiting from, or you start bringing more women into the firefighters, I mean, that's going to change that's going to change the distribution of probabilities in your mortality tables. And they're also not actually independent. I mean, if you measure a system one year and you measure it the next year, you're measuring a lot of the same people. They're not actually independent trials in the way it is when you roll the dice 2 times. These are empirical questions, not ones that you can just assume. The other problem with normal costs, I find, is that I think they're sort of philosophically wrong. I mean, a true pension system is not just an investment vehicle. It's a mutual aid pact among the members of the plan. I mean, the truth is that what funds the long and happy retirement of some of its members is that others of the members don't get to enjoy a long and happy retirement. I mean, mortality is a big bet that we all take, and all we really know is that there's safety in numbers. But what that means is that attempts to piece out the individual ownership of a piece of the pension fund are sort of acting in opposition to the philosophical position of mutual aid. It just kind of confuses things. And it also serves to sort of de-emphasize the premium income as well, and makes people think much more about the investment income. Another place where the rules kind of lead people wrong is in present value. So present value is a useful thing. Here's a graph of 20 different series of investment returns that all essentially have the same present value. And you can tell because they start at exactly the same point and they all end at exactly the same point. That's how present value works. And that's cool. But here's the same series of numbers where instead of just letting the investment grow, we're actually withdrawing a certain amount every year, which is pretty much what happens with a pension system. And there you can see that even though all these series have exactly the same present value, they wind up in very different places. Now remember, these are all systems that are actually making their investment targets. Now this gets important. I mean, so what's happening here is that there is some risk that present value is not showing you. You know, present value is masking that risk. Where this really matters is in closing a pension plan. Here's a graph of closing a pension plan, and you can see the magic red line in the middle there. That's the predicted path. But you can also see that the actual experience of any individual plan is going to be quite different. And just to be clear, you know, half of the plans are going to wind up below the magic red line. They're going to wind up in deficit at the end of their closed period. And the lowest 4 of the plans that you see on the graph there have actually lost almost a quarter of their original stake. So this is not just a rounding error. This is a significant amount of risk that present value has nothing to do with. And now remember, these are plans that are actually making their investment marks, right? These are guys that are actually succeeding in getting the 5% or the 7% or whatever it is that they're assuming. What we all know all too well is that also does not often happen, or often does not happen. Another place that risk gets masked is in the equivalence of the debt. Right? In calling the debt equivalent to another debt, you make it appear on the balance sheet just like any other debt, and that makes you think, oh well, you know, a pension obligation bond is just a simple common sense kind of a interest rate maneuver. But in fact, a pension obligation bond is actually quite risky. there's a significant difference in risk between a system that has a big pension obligation bond and one that does not, enough so that GFOA is quite clear about their recommendations about pension obligation bonds. And it seems to me that if you compare two balance sheets and one has a pension obligation bond and one doesn't, that maybe there should be some difference in the balance sheets, but there is not. It seems to me that this is also a place where a certain amount of risk is masked. There's also another issue comes up with the equivalence of assets. When you're adding up the accounts under the GASB rules, there really isn't a way to account for the composition of the assets. And the problem there is that risky assets just do not contribute to the security of a system. In 2016, insurance companies pulled out 28% of, the insurance companies' investments in hedge funds went down about 28%. That same year, pension funds brought their investments in hedge funds down about 6%. Insurance companies, though, haven't put it back, whereas most of the hedge funds have. So this is also a way in which that in which risk is masked by the rules. There is also, I think, a certain kind of moral hazard in the way the rules work. You have the government over here, you have the pension system over here, the government does something over here, it affects the pension system over here, and eventually it affects the budget of the government over here, but there's a lag of a couple of years, at least. And it's actually relatively easy to engineer decisions, policy changes, to make sure that the lag is even longer. And that's a problem because accountability sort of demands that somebody who makes a decision is, that everybody else is able to evaluate the quality of the decision before it's too late. But with pension systems, it's often decades in between the action and the consequences. And the other thing is that, and so that lack of accountability creates a political risk. But the other issue there is also that that by the time, even if the same person is still in office, by the time you know that something has gone wrong, it's a complicated world. Enough other stuff has happened that the person who made the bad decision can always say, oh yeah, but that was because there was a downturn in the market, or oh, that was because the Fed raised interest rates, or something like that. And so accountability becomes very cloudy, and I think that becomes a real source of political risk. Another source of political risk is in overfunding, and I know that that's not usually an issue on people's minds, but I do think it's worth considering because, after all, 100% funding is the goal of the rules, and overfunding is one good investment year beyond that. But the issue is that when people think about full funding, a lot of times what I feel when I'm talking to policymakers is that they imagine that full funding is sort of an entry into the Elysian fields and that everything is going to be inexpensive and easy to manage after that. But in fact, that's not usually what happens. Full funding is a way to invite some kind of benefit increases or decreases in contributions. Chicago's systems were pretty much full funded in the late 90s. And as a result, they voted a bunch of benefit increases, and they voted themselves a 10-year pension holiday. They skipped 10 years of, actually they wound up skipping like 13 or 14 years before they finally got back to making contributions. And the result is that I think it's pretty much a law of nature that a fully funded system doesn't stay that way. And I think that that's something that the rules don't really acknowledge, but is really a reality of our world. And there's another political risk that I think is worth pointing out, something that I think maybe even you guys may not realize about pension assets is how recently they've been accumulated and how quickly. There's $4 trillion in state and local pension assets now, and almost all of that has been accumulated since the 1980s. Just for comparison, the US GDP is about $19 trillion. Okay, but that GDP, that took 400 years to accumulate. What that means is that in the 90s and 2000s, there were years when the bulk of the nation's economic growth was devoted to the purchase of financial assets by pension funds. And just think about that for a minute, and think about why, we were wondering, like, what happens to reinvestment? How come the math isn't working on our national accounts in the 90s? And here is a potential answer that I think people don't widely acknowledge. All right, so I only have a few minutes left. What can you actually do about this? Let me recommend the report to you, which goes into this in glorious detail, but I'll try to run through the things quickly. To start with, I think that you could do a lot better costing. An analogy I'd like to make is with airplane navigators. Imagine yourself a pilot in World War II in the South Pacific, and you're trying to find some island out at the ragged edge of the range of your airplane. If you aim directly at the island, and you fly 6 hours to get to the island, and you don't see it because your course was a little bit off, you have a choice to make. You can turn toward the island, and you don't know which way that is. You turn left or right. One way is toward the island, and you live. The other way is away from the island, and you die. And that's a terrible position to be in. And so people did not navigate by aiming straight at the island. What they would do is they would navigate a little bit to the left of the island, and they set their course a few degrees to the left, so that when they got to the end of their 6 hours and figured out what to do, and didn't see the island, they at least knew which way to turn. And then they'd turn, and they didn't have to make a life or death decision there. And I think that we can do something like that with blending the costing. Like, you can't use standard costs alone to manage a pension plan. I mean, they keep errors in check, but they don't look into the future. A standard cost is just a how do I correct for what happened last year? On the other hand, normal costs, as we've seen, they look into the future, which is their advantage, but they're also mostly wrong. And I think that what you can do is treat them like the navigators. If instead of trying to assess with 100% of the normal cost, you can assess the 50% of the normal costs. If 50% don't spiral out of control, then 100% isn't going to either. So I think that there is a way to make a blend like this that works. The blend can't be precise, but the current system isn't precise either. What I think is also interesting is that people essentially are using a blend right now. They use the amortization costs as a way to blend it, but the amortization costs come with a sort of a taint of failure, and this, I think, would be a way to get around that. Another thing is, I think, a better balance sheet. There's something called the fundamental accounting equation, and I think it would be great if pension plans would actually, if we could come up with an accounting that actually honored that. Maybe there'd actually be capital, so that the capital and the assets could, the capital and the liability could add up to the assets. We should treat them like a permanent thing. I think that this can be done by assessing the value of a government's promise to pay the standard costs in the future. I think that that's a realistic thing. That's a thing that can be valued just like a bond. It sort of begs the question of what the standards are. There are decisions that still have to be made. Do you do this out 10 years, 20 years, whatever? But the pricing apparatus is already in place and already well known. I think it's important for us to acknowledge that a pension plan is a permanent institution. You shouldn't really chafe at the permanence. You should use it. And I should put it aside here too that I'm talking about public pension plans here with an infinite time horizon, but I actually think that had private pension plans done accounting more like this, that they would have been harder to loot by the private equity guys in the 70s and 80s. I think that we can also look for better planning values than a funding ratio. I think a depletion date has some significant advantages over a funding ratio in terms of honoring the philosophical basis of a pension plan. Also, the predictions don't tend to go out as far into the future, so they tend to be a little bit more reliable. It's already something that people are doing at the moment, so I think that's not too much of a problem. These kinds of things would require some smoothing, but here's another thing. There are better ways to do smoothing than moving averages that are sort of out of fashion now. They're out of fashion for a good reason. In the rest of the world, in the rest of science, nobody uses moving averages. There's a thing called a Kalman filter, and there's a particle filter. I mean, the math for doing pensions was mostly developed in the 1920s, so that's almost 100 years ago. We have learned some things since then, I'm happy to report, and I think it's not a bad idea for the pension industry to take account of those. I think that there's also room for doing better valuation of assets. Again, risky assets don't add to financial security, so they should not be counted at full value. But the evaluation of assets in a pension plan is only done sort of irregularly in occasional asset liability studies. However, risk weighting like this is completely routine for banks, and insurance companies too have limitations on asset categories that act in kind of the same way. I think that it would be very useful for pension funds to adopt something like this, and it would also serve to cloud some of the unwanted semantic freight of the depletion date, which I think would also be useful. Something like this, I think, would also require a valuation of the local economy. I mean, ultimately, what guarantees the security of a pension plan is not actually the store of assets that have been accumulated, but it's the strength of the economy behind it. This is why I worry much more about the I worry much more about the pension fund in Kentucky than I do about the one in Illinois. That one of these states has much more of a capacity than the other one to make up any difference. This kind of thing is sort of a commonplace in the bond market. I mean, this is how bonds are rated, and it seems to me that this is also some place that we can learn from for pension funds. Something like this also would have some consequences about what constitute responsible investments, and make it more clear that there is a role for economically useful local investments from a pension fund. For example, if infrastructure investments might be economically useful, this is a framework under which they could be considered. So, what does this all mean? I think that these alternatives can actually be combined. That you can take blended costing, like I was describing, and that can be combined with risk weighting of the assets and a depletion date accounting, and and valuation of the promises to pay over time. I think that these things can be combined into a more promising framework than the status quo accounting rules. I did do an exercise on this with Carlsbad, California, that you can read about in the report. But in a quick summary, I mean, Carlsbad I chose kind of randomly because partly because it's a medium-sized city in California, and it seemed to not be in terrible trouble, but and also partly, I guess, because the primary documents for Carlsbad were sitting on the floor of my office because I'd been doing some consulting for them, so, randomly chosen. But what I did was model what these rules would look like, making assumptions about the choices that would have to be made about the framework. And it's not so hard to see that you could make the framework work. You could save a little bit of money for Carlsbad, and still, at the end of the year, you calculate in 1 year, you calculate that the depletion date with the risk-weighted assets is 82 quarters out into the future, 20-something years out. And then you put in a little bit of money for the standard costs, and the new depletion date is now 82.1 quarters out. That means that the system is now in better shape at the end of the year than it was at the beginning of the year. And we've actually put in a little bit less money than Carlsbad is currently putting into the system. So the prospect is that you could save a little bit of money and still be confident that the system was better at the end of the year than it was at the beginning of the year. And I think that that's really what it's about. There's 100 years of regulation of banks and insurance companies that we can learn from. And I think that it's those rules have undergone quite a lot of change and modification over time as we've learned from one crisis to the other. There are opportunities to copy important features from those regulations and use them for public pension plans to make the plans more secure over time, and make managing them a less fraught enterprise, and by being less fraught, ultimately be more secure. And really, that's what the goal is here. So that's what I've got to say, and thank you very much. And